Bitcoin is a decentralized digital currency that was created in 2009 by an individual or group using the pseudonym Satoshi Nakamoto. The primary goal of Bitcoin was to enable a peer-to-peer financial system independent of central banks, governments, or traditional financial institutions. Since its inception, Bitcoin has grown to become one of the most well-known cryptocurrencies and has sparked a global revolution in the world of finance and digital assets. One of the most innovative aspects of Bitcoin is that it operates without a central authority. Traditional currencies are issued and regulated by governments like the Federal Reserve in the US or the European Central Bank in the Eurozone. Bitcoin, on the other hand, is decentralized. This means no single institution or entity controls the Bitcoin network. Instead, Bitcoin transactions are verified by a distributed network of computers called nodes, ensuring that there is no central point of failure. This decentralization is made possible by a technology called blockchain, which serves as the public ledger for Bitcoin transactions. Every time someone sends or receives Bitcoin, the transaction is recorded on the blockchain, which is a chain of blocks that store information about all Bitcoin transactions that have ever occurred. This distributed ledger is transparent, immutable, it cannot be changed once added, and is constantly updated by all participants in the network. To understand Bitcoin, you need to understand blockchain. A blockchain is a chain of blocks, each containing data about transactions. Each block is linked to the previous one, forming a chronological chain. In the case of Bitcoin, every block contains a list of verified transactions, a timestamp, and a cryptographic link to the previous block. The blockchain is maintained by a network of miners who validate and confirm transactions by solving complex mathematical puzzles. This process of consensus ensures the integrity and accuracy of the blockchain without the need for a central authority. Blockchain has many applications beyond Bitcoin, including in areas like supply chain management, healthcare records, and voting systems. But in Bitcoin's case, it serves as the decentralized ledger that tracks all Bitcoin transactions. One of the key features that differentiates Bitcoin from traditional currencies is its limited supply. Unlike fiat currencies, which can be printed or issued in unlimited amounts, Bitcoin has a hard cap of 21 million coins. This was designed by Satoshi Nakamoto to introduce scarcity into the system similar to precious metals, like gold. Why is this important? The idea behind limiting the supply is to create a form of deflationary currency. In traditional systems, central banks can print more money, leading to inflation. When too much money is in circulation, the value of each unit decreases. With Bitcoin, however, because only 21 million will ever exist, it's often referred to as a store of value, similar to gold, which tends to hold its value over time, especially in periods of inflation. As of now, about 19 million Bitcoins have already been mined, meaning only around 2 million remain to be mined in the future. The rate at which new Bitcoins are introduced into the market is halved roughly every 4 years in an event called the halving, which limits the rate of inflation and adds to Bitcoin's scarcity. Mining is the process by which new Bitcoins are created and transactions are verified. Miners use powerful computers to solve complex cryptographic puzzles. The first miner to solve the puzzle gets to add a new block to the blockchain and is rewarded with newly created Bitcoins. This is known as the block reward. The difficulty of the puzzles adjusts every 2 weeks to ensure that new blocks are added to the blockchain approximately every 10 minutes, regardless of how many miners are participating. This system is what guarantees Bitcoin's security and prevents anyone from controlling the network by simply adding fraudulent transactions. However, mining is energy intensive. The process requires significant computing power, and the energy consumption of the Bitcoin network has been a topic of ongoing debate. Some argue that the environmental impact of Bitcoin mining is too high, while others argue that mining incentivizes the use of renewable energy sources and is an essential part of Bitcoin's decentralization. Bitcoin uses cryptographic techniques to secure transactions and control the creation of new units. The key elements of Bitcoin security are public keys and private keys. Public key, this is like a Bitcoin address. It is used to receive Bitcoin and is visible to everyone. Think of it like an email address to which people can send funds. Private key. This is a secret key known only to the owner of the Bitcoin. It allows them to sign transactions and prove ownership of the Bitcoin. If someone else gains access to your private key, they can spend your Bitcoin, so it's important to keep it secure. Bitcoin transactions are pseudonymous. While they are publicly recorded on the blockchain, they are not directly tied to personal identities. Instead, transactions are linked to alphanumeric Bitcoin addresses. While this provides a level of privacy, it also means that if someone can connect a Bitcoin address to a real-world identity via an exchange or transaction pattern, the user's financial activity can be traced. Bitcoin's security features make it highly resistant to fraud and double spending, which is trying to spend the same Bitcoin twice. Each transaction is verified by multiple participants in the network, and once a transaction is added to the blockchain, it's nearly impossible to alter. Initially, Bitcoin was designed as a peer-to-peer electronic cash system, enabling people to transfer value directly between each other without intermediaries. Over time, however, Bitcoin's value and use case have evolved. In the early days, Bitcoin was used for direct transactions, where people could buy goods and services using Bitcoin. Some vendors still accept Bitcoin today, although the adoption of Bitcoin as a day-to-day payment method is limited due to its volatility and scalability issues. Over the past few years, Bitcoin has increasingly been viewed as a store of value. Similar to how gold is used, this is because its supply is fixed, and over time it has shown potential for appreciating in value, especially during economic uncertainty or inflationary periods. Many people consider Bitcoin to be a safe haven asset, especially during times of financial instability or currency devaluation. Institutional investors like hedge funds and publicly traded companies have also begun to treat Bitcoin as a digital gold or a hedge against inflation. One of the most notable characteristics of Bitcoin is its price volatility. The price of Bitcoin can fluctuate wildly in a short period, sometimes by thousands of dollars within a single day. This volatility is driven by a variety of factors, including market sentiment, investor speculation, regulatory news, technological advancements, and macroeconomic events. While this volatility has made Bitcoin a risky investment for some, it has also provided significant returns for early adopters and long-term holders. However, Bitcoin's volatility has been both an advantage and a challenge. On the one hand, traders can profit from price swings. On the other, it makes Bitcoin less practical as a daily currency for many people. Bitcoin's creation has had profound implications on the world of finance. It has given rise to the entire cryptocurrency market, leading to the creation of thousands of other digital assets. Furthermore, Bitcoin's decentralized nature has raised questions about the future of traditional banking systems and the role of governments in controlling money. There are a variety of use cases for Bitcoin, ranging from remittances, cross-border payments, to digital asset investment, and even as a potential tool for people living in countries with unstable currencies. Looking ahead, the future of Bitcoin is still uncertain. Some believe that Bitcoin will continue to gain adoption and be used as a global store of value, while others argue that it faces challenges such as regulatory scrutiny, scalability issues, and competition from other cryptocurrencies. Bitcoin has not only created a new form of digital currency, but has also sparked a broader revolution in the world of finance, decentralization, and digital technology. Whether used as a peer-to-peer payment system, a store of value, or a decentralized financial tool, Bitcoin has paved the way for a new era of digital assets. As with any emerging technology, it carries both risks and rewards, but its impact on the world of money and finance is undeniable. Whether or not Bitcoin achieves its full potential remains to be seen, but its creation has undeniably changed the landscape of finance forever.